Hi everyone, this is Rufaro here and welcome to my channel. Truly thank you for joining me today and welcome to part two of my series on insurance. Insurance, why on earth am I talking about insurance? Well, this is the place Shivani has talking about things to really help you guys be better and be great, right? And we insure so many of our things. We insure our cars, our homes, our gadgets, people insuring hair, their, everything. But is your life insured? Do you have life insurance? Because we are all going to die. We're all going to die. That's a given, right? And why not create a situation where you're going to leave your family in a better situation? You're going to leave your family in a situation where they're not creating group meals to help you or things like that. You're going to leave behind a legacy for your children, for your family. And so today I brought in the video that we recorded, I have the lovely Tiana who literally is just going to just dive into it and just break it all down for us. Explain what life insurance is, how it's an investment. Literally, she was telling me things I didn't know, and honestly, she'll be telling you all a few things that you didn't even know about life insurance and at what ages you can get it, what to do, just the whole process. And again, after this video, there will be another one because we recorded a super long video and I decided to break it down so you can all absorb small bits of information at a time. So definitely look out for a part 1, 2, 3, part 3 as well. That will be dropping on life insurance. So please go ahead, like, subscribe, comment, and
Now
let's
dive
get into
into
it.
life insurance. Okay, so let's just give a scenario, right? I'm
Mm-hmm.
looking to buy life insurance. This is the first time I know nothing about it. All I know is that I need to buy this insurance because I'm going to die one day, but I don't know what happens. How do I get that money? Who gets it? Can I, all those questions. Let's start with the process of where do I even start? Who do I go to? Or, I come to you and how are you going to help me? What do I need to know?
Okay, cool. So you said, hey, listen, it's that
Mm-hmm.
I gotta get my life insurance. First things first is you're gonna have to seek out a licensed professional, so someone who is life insurance licensed, in order to help you facilitate that. So that's not something that you can go and open up on your own necessarily. Now you can go online and like look at quotes and look from people, but it's gonna be the licensed person that actually facilitates. Right? So now when you say, okay, great, I've spoken to somebody, we're sitting down, I need some help. First and foremost, there are different types of life insurance. And so, depending on what your need is, that'll kind of determine which direction we're going to go. So, if you want to stay in a more broad spectrum, there's two main categories when it comes to insurance. It is something called temporary or term insurance, and then there's permanent insurance. Now, under the permanent umbrella, I would say about three other main categories that I would dissect it into. A whole life, universal life, and then a variable life, right? So all this really means is, are you looking for first and foremost something that's temporary, maybe 10, 15, 20 years, where you're saying maybe I'm like 70 years old, right? And I said, but I don't think I'm going to live past 90. Give me a 20-year, policy. I can pay out my kids, my grandkids, and I'll be okay, right? Or you may say, you know what, maybe I bought a home and, I can't afford to pay for such permanent coverage to cover the entire amount of the home, but I can get a temporary coverage that's a lot cheaper. Maybe I have a 15-year, mortgage. Let's just get a 15-year term and I'll be okay, right? So depending on what your situation calls for, that'll dictate what type of insurance you want to get. Once we figured out the type, and we'll kind of backtrack and go a little further into the types,
Mm-hmm.
but once we figured out the type of insurance, the next step would really be to set up a medical. So it really depends on the state. Certain states don't require medicals in certain companies. But typically speaking, you need to qualify medically, right? Because when you go back to the definition saying risk management, if the company is willing to pay out maybe 100, 200,000, or even $1 million to whoever you leave, they want to make sure that, you're healthy and you're not going to die tomorrow, so to speak.
Yeah.
They'll ask you some questions. How's your height and weight? How's your medical history? Are you taking prescriptions? Do you have any chronic illnesses? Anything that would really be deemed as a big risk to them. And that'll determine either your health rating or if they're going to approve you at all. Based on the health rating, that's when you really get your price standpoint. And then you can determine, okay, great, this is the rating I got. This is how much it'll cost. Does it make sense for me to continue?
Okay, so after you get the medical, you can pull out and say, I mean, no, everyone needs it. You can pull out from a different like cover that you were looking to get and figure out which one it is. So for instance, what you're saying is, let's say if there's a person and they have a health history, like in the family, they've been sick before, they've all these things. So does that mean that they're more likely to pay more?
Yes. So family history doesn't matter, but your individual history is what is important. So if you're someone who has been hospitalized frequently in the last couple of years, especially for something specific or the same thing over and over, that's going to be considered a high risk. Now, if it's just that, you're just clumsy and you broke an ankle and an elbow and things like that, they don't care about that. That's fine. Those are like one-time things, right? But they're looking for chronic, ongoing situations. So maybe if you have, let's say that you have asthma, right? But it's controlled, that's okay. But if you have asthma and it consistently leads you to be hospitalized, maybe you get pneumonia from it over and over, they're going to look at that as a high-risk situation and really bring down the health rating, right? Or if you have maybe like a sickle cell anemia, for example, that is prevalent, not just dormant, that may be something, right? Because this is something you're going to battle on an ongoing basis. So those kinds of things are what they're looking for. Family, if you have family that says, listen, everybody has blood pressure, everybody has diabetes, but I haven't gotten it yet, you're okay, right? They don't care about that stuff, but they're looking for you in particular to see what's been going on in your life, how is your height-weight ratio, things like that.
So people need to get on this life insurance now while they're still young.
ASAP, absolutely.
Yeah, okay. So what about, like, what age do you recommend people to get this? Can you get your life insurance when you're in high school, when you're in college? Or
yes, you can. So you can get life insurance from the minute that you were born, right? You're not going to be the one buying it. Your parents will buy it because when you're 1 year old, you're really not thinking about anything. But you can be insured literally from like 2 weeks out. So, the earlier that you get it, the better, because the younger and healthier you are, the cheaper it is. And especially when you're looking at something like a permanent type of coverage, if you have this and you said, okay, great, maybe my parents set this up for me and I was 10, they got me $100,000 policy, you're set for your life. Like, you don't even have to think about it. If you feel that you're never going to need more coverage than that, you're good, right? You've locked in your insurability rate, you're good to go, right? Now, if it's, hey, listen, maybe, I didn't have the fortune of my parents doing that for me, and now I'm 18 or I'm 19 and I said, hey, this is a great idea, I want to get coverage now, you absolutely can. So there's no age, minimum for when you can start. Now, there are maximums, though. So once you're in those 80s or so, 90s, depending on the type of coverage you get, like terms, for example, may not, issue, depending on the company. It may be a bit harder at that point. So the earlier you are, or the younger you are, the better it is.
Okay. That makes sense. So let's backtrack. I know earlier on when you're talking about term and whole life and all of that, could you break down really, could you break those down further?
Of course. So let's start with term because it's the simplest. So a term is just a temporary coverage. It's set for a certain amount of years. It has no cash value. It's only death benefit. So going even further back to what life insurance really is, it means that God forbid something happens to you and you die, you pass away, we're going to leave a lump sum of tax-free money to someone else that you choose.
Tax-free. I just said tax-free.
Huge. Tax-free. They will not tax this money. So we're going to leave it to somebody else, and they will be the ones that benefit, or they're beneficiaries of your policy, right? When we look at a term, it's all death benefit. There's no cash value because some of the permanents actually have cash value, which is what we'll step into next. So let's say that we want a 10-year term. I only want this coverage for 10 years. I got a $500,000 policy. That means God forbid something happens between now and the 10th year. My company, will pay out my beneficiary and I'm good. However, at the end of that time period, your coverage does expire. Okay, so it is no longer locked in. So what you typically want to do with a term, and the way that it makes sense, if you feel that I can't afford a permanent right now or it's not the right time, you can lock in your insurability with the term and do something called converting it to permanent before it expires. So a lot of people ask, well, I don't think terms make sense because all we're doing is throwing money away. It's like renting. Once you're done, it's gone. Not true. I mean, yes, it's true in the terms of, you're not going to get the money back because you were paying for coverage at that moment, right? It's like auto insurance. If you pay for your coverage now, just because you stop 10 years from now, they're not going to come back and say, okay, let's get the money back, right? But if you convert it to a permanent policy, some companies will give you like loyalty credits or actually give you cash to convert it. And now you're set for the rest of your life. So that was just term. Now on the permanent side of things, with the three main types, let's go into whole life, is the oldest type of permanent insurance, right? It is also the most expensive type, generally speaking. So what happens is there's two main components to it. There's the death benefit, which is God forbid something happens to you, we leave it behind. Then there's a cash value side that you're allowed to use while you're alive. So we say, why do I want insurance? It's really not that great. Here's a good side. You actually get to use some of this cash value while you're alive, right?
And you don't incur a penalty at all?
No, so it depends on the type of contract, the way you use it, but it's not penalized. Like it won't necessarily say, okay, if you want cash value, you're gonna lose out on certain things. Depending on how the contract is set up, they may use it differently. So typically with a whole life, if you have cash value, you're gonna be required to borrow against it, like a loan out of it, right? But now you're gonna, as opposed to maybe getting a bank loan for 6, 7, 8%, depending on the whole life contract, it may be like a 3% or 4% loan, right? So if you said, okay, great, I've got $100,000 in cash, I want to go buy a home, maybe I can take this money out and use this as a down payment. Now you just pay it back into the policy, right? So typically, God forbid something happens to you and you have a loan out, your death benefit would decrease, right? So that they can offset the loan balance, really clear it out, just like that, and now they'll get the remaining amount. With the universal life, it is a flexible permanent policy. So whole life, whatever the premium is, and the terms as well, that's what you're paying every single month. Okay. If it's, $20.81 or $100.59, you're paying that every single month. You can't change the amount.
Wait, question before you go to the universal. So for the whole, let's say I've been paying every single month and then, hey, Corona came, I can't pay this month. What happens?
So what'll typically happen if there's a cash value component in there, like you have money in it, they can draw from cash value to float it. But typically, if you're not able to pay and there's nothing there, it'll go into a loan foreclosure. Same way your home can foreclose, your policy can actually foreclose as well. So, at that point in time, if you're no longer able to make the payments, if you're upside down on a loan or anything like that, and it gets foreclosed, any cash value at that point gets treated as taxable income. So you may end up hurting yourself on the tax side.
Okay. No, this is all like good information. Okay, now
now I'm here for you. So some people, they hear that and they get a little concerned, like, because question, you never know when things are going to come up. What if I can't afford really do what I'm always doing right now, but I really need the coverage? It may make more sense to get a flexible type, something like a universal policy. So the way that universal is designed, it's also permanent. It still comes with the death benefit and cash value, but now you have flexibility in the premium. So you may be saying, okay, great, every month I'm putting away $100 a month, but they may only require like $50, right, to keep going. Maybe the rest of it goes towards cash. If you're ever in a situation where you said, okay, great, I can't, pay the same thing, no problem. Maybe we can decrease it to $50, right? If you have enough cash value, you may actually skip some months because they'll just draw it from the cash value side. So you don't have to feel like, okay, great, now I have to forfeit my death benefit. I have to worry about all this loan foreclosing or anything like that. You'll be okay. So biggest thing with universal life, flexibility. That's really what you're looking for, right? Now, some people will say, okay, great. Well, how does the cash value grow? Typically, it's through like dividends or a guaranteed interest with like whole life and these things. it's not going to grow too crazy, right? So if you say dividends, guaranteed interest, you're talking about maybe 3% a year, 4% a year max, right? So some people might say, okay, great. That sounds nice, but I want more than that, right? You know, I'm selfish. It's great that there's somebody else who's going to get the death benefit, but I want really good cash value. Give me the 8%, give me the 9%. But it may make more sense for them to get something called the variable universal life.